Welcome to TMS Insights. It's January 2020. The month has ended after a period of some holiday and break and rest, while the markets have been trading very well, continuing on from a great 2019. Ben, Happy New Year.
Thanks, Jeremy.
And looking forward to a great year. Ben, on reflecting on last year, you immediately go forward to forecasts, and you see them all over the financial press at this time of year about what the year ahead could be. And invariably, a lot of them will be wrong because forecasting is notoriously difficult. But looking back, I mean, it was a terrific year last year.
Yeah.
And most years tend to be positive. But some interesting findings when we consider, and going to this table here that we've got showing the 120 years of returns in the Australian market and how 97 of those have been positive.
Yeah.
Just what does happen after a terrific year like 2019 more often than not?
Yeah, I thought this was a great graph to show clients for a couple of reasons. The first is, and maybe the more interesting part of it is that there's actually statistically zero correlation to if we have a bad year after a good year or a good year after a bad year. It's just as likely to occur. So just because we had a good year last year, there's an even chance that we'll have a good year again this year as opposed to a negative year. And there's after a really bad year, there's just as good a chance that you'll have another bad year as opposed to a good year. But so that's the first takeout. We should say Benelong Asset Management put out this chart, and it's a cracker, because I thought the other really good thing about it was everyone can develop a bit of mentality that they can pick the next bad year or they can pick the next crisis. And what this sort of shows you is that A, it's impossible to pick, but B, if you are trying to do that, you've got roughly a 19% chance that you'll be right. So over the last 120 years, there's only 19% of them have been negative. And actually half of those years have only done a return of -0 to -10%. So they actually haven't even been that negative. The graph also shows you, and we can send this out because it's probably looking a bit small on the video. We can send the TOR chart. You can see there are the number of years where we've had a 10 to 20% return.
So that's the most common occurrence? Yep.
That's the most common occurrence. And then the second and third most common occurrence are either 20% to 30% or 0 to 10%. But you can see also there just how nasty a year the GFC was. We've never had a year of -30 to 40%. We've only had 3 where it's done -20 to 30%. And of course the one year that was the GFC. So although I know the GFC still feels quite fresh in a lot of people's minds, it's statistically extremely unlikely probably to happen for another 100 years when you look at this look at this table.
It was a real outlier, wasn't it? And I guess moving into the current now, Ben, because we do want to have some sense of 2020, and it will impact, notwithstanding the difficulty of the forecasting process. But the month of January has been good on the back of predominantly, a benign interest rate environment that's been continuing. We haven't had any escalation. The trade war issue and most of the economic data out of the US, including reporting, has been quite good. But locally, we've had a few issues, haven't we?
Yeah.
We know this week we've been dealing with the coronavirus issue, which is a global issue. It's affecting global stocks quite significantly. And of course, in Australia, the summer's been marred by bushfires. So these are both things that are impacting, definitely will impact on profits for companies in the short term. But often, as we say, Ben, that creates a longer term opportunity.
Yeah, I think that's, you've put it exactly right there, Jeremy. I think in the upcoming earnings season, we are going to see some companies warning about what's happening with the Chinese. And we will definitely, and we already have seen a number of companies downgrade earnings on the back of what happened with the bushfires. So, but the market, I think, to a point, will look through that. And, I think for the market as a whole, what this, with the bushfires, what this has created is we're going to see quite a significant stimulus package come through as the building effort takes hold. And, the complete uncertainty is the coronavirus. We just don't know how far it'll spread, how nasty it could become. I did see someone say this morning in the press, and I thought it was a good point, that Around the world, about 600,000 people die every year from the common flu. And so far we've had about 100 from the coronavirus. So, but it's the fear.
And it hasn't ended. That's the other thing.
Yeah.
So we'll assess it better when it's all done, if you like. But going back to the bushfire, the number of the companies that have given profit warnings, there have been a few, have actually been exposed to the construction industry, not related to the bushfires in any way. But they're some of the beneficiaries of the spend that will happen. We know the Morrison government's quite prepared to move away from their pledged surplus to spend up to rejuvenate the economies that have been affected, and that will enhance the infrastructure, construction sectors enormously.
Yep, absolutely. And it should create jobs. And I guess there's, as we sort of said in the last video last year, is that the thing everyone has, the market will have their eyes on is inflation, and any signs of inflation, where creates a bit of pricing pressure during the year, which we have seen when money was sort of sprayed around in the past.
And while we're on that, CPI actually came out today for the December quarter, and it was just above expectations, which is actually a good thing.
Yeah, definitely.
And it's reduced rate cut expectations, which, again, it's just something to bear in mind.
Yeah.
But we did have a 10-year bond down to 1%. So it's a lot lower than when we last gave a video in December. So talking about some of these companies, Ben, Downer and CIMIC were a couple that warned. We heard from Treasury Group today. Now, that was a really, I suppose, unexpected but very dire sort of set of numbers that they were forecasting for the year.
Yeah, look, so this is Treasury Wine Estates, and, everyone was sort of starting to worry that they'd have a flow-on effect from China, people drinking less, celebrating less during the new year, drinking less Penfolds premium wine. But their issues have come out in America, actually in the mass market sort of area, and it sounds like a bit of a flow-on of the trade issue with China. I think the thing it highlights to me is that, and we've said valuations do look a bit stretched at the moment. It's much harder to find businesses which we think are high quality trading at reasonable valuations. And I'd say the first thing is, reporting season's going to be interesting because Treasury Wine's fallen 25% today, and it's a big company. So anyone that misses, we're going to see a bit of volatility from, and I'm sure we're going to have a couple in our portfolios, and hopefully not to that extent. And the second thing is just owning companies that have got pricing power. And, what we've seen is, a couple of other names, Acosta Group, New Farm, companies which have suddenly been hit by others discounting and they've had to respond. When you can find businesses that can consistently increase the price of the service or the good that they sell each year without any real pushback from customers or competitors, you want to hold on to those businesses. You don't want to sort of feel you need to take a profit and move on somewhere else and end up in what could be a lower quality business.
And there's some of the bigger companies that have done well in portfolios, CSLs, REA groups, and that they don't really have this issue. They don't have to compete. They're either a monopoly position in their particular line of business or a cosy duopoly or oligopoly.
Yep, and the demand for their product is increasing year on year on year on year, and they're well managed and they have high returns on capital. The thing is, there's not a lot of businesses on the market that have these qualities. That might be less than 1 or 2%, I suspect.
And I think sort of segueing into the international stocks, a lot of the US stocks are reporting ahead of our February reporting here. It's US reporting season now. But, we have been telling people in the videos about how we are finding better value in terms of high quality growth businesses with high returns on equity that are listed in New York and in the US and overseas and not here. And one that stands out particularly because it's got that China flavour and has been hit a little bit as a result of the coronavirus, Alibaba. Yeah.
And so this is one we were both doing some work on at the end of last year, and we're trying to flesh out the number of stocks we hold. It's been about 6 months that we've been doing this now, and it's been a very good 6 months to be in the companies that we've got so far. Baba, the numbers look extremely attractive, and this company will have about $500 billion in cash on its balance sheet next year. 2 or 3 years out, it's trading on a P of about 18 times with a return on equity that is higher than that, despite reinvesting huge amounts of capital back into the business. And, you know, it's effectively the Amazon, the Visa, the MasterCard, the Uber, the eBay of China.
Fantastic,
So it's a collection of businesses that you get in one hit. And, you know, the share price of BABA's fallen about $25 on the back of these flu issues in China, and I suspect might fall a bit further.
Could do, yeah.
It's
one
up
from a year ago, but not as much as some of the other names we've talked about in the US. So it's really one that we will focus on and talk to you all about more, but it's an outstanding one. So just the last wrap, we'll be coming back to clients on the videos in February with 2 updates regarding the Australian reporting season and also an update about the US reporting season. Ben, best messages for clients now is obviously we want to be careful. We don't, we're very aware of potential risks going into reporting, but I think the opportunities will actually be greater.
Yeah, I think so, because I think you're going to get greater volatility this reporting season because of the run we've had going into it. So I'm still optimistic on the outlook for the year, but probably a bit more cautious certainly than we were this time last year, because we're coming off a hot year as opposed to a cheaper valuations this time last year. But the interest rate driver is still this thing I can't see. It's going to change, and so there'll be sort of periods where the market looks a bit cheaper, I suspect, and it's I think maintaining your asset allocation. And as we said at the start of the video with the chart we showed you, sticking with equities for the long term and not trying to predict, the next sort of nasty year, because the chances are you'll get it wrong.
Yep, great advice. That's all we've got time for today. More updates in February.